Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets.
Ice raw sugar in New York. The main immediate pattern here since September 2024 had been, I suppose still is, after a fashion of sorts, the breached and seemingly repaired dark blue September to December 2024 bear channel. It's currently 1615 to 1933. Though in recent times, the bright pink late September 24 to mid-January 25 bearish Andrews pitchfork, which I drew 9 weeks ago to try and help make some sense of the recent moves, is a seeming better contender in showing the bearish angle attack of this market. On this one, we are today in between the middle time below, currently at 1655, and the upper time above, currently at 1911. However, there is also, complementing this bearish Andrews pitchfork, the larger, longer term, bright red, November 23 to September 24 bearish shift pitchfork, which has also been pretty good at showing the bearish angle attack. We are today, as we have been since mid-April, close to the bright red middle time below of this, currently at 17.25. This bright red middle time, along with the bright pink middle time, have helped hold up the market, even though they are bearish patterns on a number of occasions, especially recently. However, all these three are still indicative of a market pushing lower. But, as I said 2 weeks ago, and I quote, we have also support below from about 1750 down to about 1650, though it is a declining support. And once past the pink middle time, the support begins to dissipate. End of quote. Now, a key support that has been breached and is now acting as a resistance is the important overhead level at 1809. This level has impacted the market every time we've seen prices come down to that price, because it is the interesting 50% absolute Fibonacci line for the whole of the 21st century. We challenged this level as recently as yesterday, and possibly maybe even today, when prices tried to reach up to fulfill topside targets for the small double bottom pattern formed over the last 2 weeks. Now, the primary targets are reached, but the hardest to reach secondary target is up in the 18.25 area, and it's still open, though because of this resistance at 1809, I'm having some doubts whether it's going to be achieved. Just in case, further up we have the 50% Fibonacci, the April 20 to November 23 move at 1859, though this is not of the same magnitude as the 50% absolute Fibonacci line. However, in the past, these two 50% Fibonacci lines worked together and had been a significant support and an eroding force for some, if not all, of the bearish incentives. Now, I also went back 3 weeks ago back to my monthly charts in a further effort to get a handle on what technicals were operating there. And the major pattern I saw there, which is still working, is the double top, an Adam and Eve type that had been constructed throughout 2023. This had already reached its primary target 1880, but it's still left alive and operational, the harder to reach secondary target X down at 1630. This, as I said so for many weeks, this longer term pattern is the one I choose to watch and see how it develops. However, it all depends if prices can properly break down through the bright red middle time and below the pink middle time, and then exploit the move further down. Ice Europe white sugar in London. After all this time, there still continues to be 3 features in this market to bear in mind on this daily chart. The first is the obvious and broken, though now coming back once more to being repaired, purple late September 24 to mid-February 25 descending expanding wedge pattern, which is currently 512 even to off the bottom of my daily chart. This pattern has more than the requisite 5 touches necessary back in January and has been severely tested on the top side ever since late February. Enough that I would not classify it as a descending wedge pattern after February, though I'm still keeping an eye on the extensions to the trend lines, especially the upper trend line, which is currently at 512 even. The break upwards in mid-March reached up as far as the February 2017 high at 565 even, and in the process raised a question as to whether the action since February was a form of bullish halfway hesitation, or a double top, or something else. Today we can see it as a double top, though there had been a marked reluctance to fulfill its potential on the downside. Nevertheless, the primary target which I had previously highlighted was at 492.80 and was reached mid-April. A secondary, much harder to reach target X is down in the 464 even area. We've had attempts down towards the number, but it is, as I said earlier, with reluctance. Hence, this is why I said 4 weeks ago to, and I quote, also keep an eye on the bright pink late September 24 to mid-March 25 recently finessed bearish shift pitch walk. We are right now in between the overhead upper time, currently at 555.5, and the middle time below, currently at 497.20. This is a very shallow pitchfork, and the more the market moves lower through it, the more I'm beginning to like it. End of quote. Well, since then we have seen the market start utilizing the bright pink middle time as an attractor, riding prices lower in a shallow glide. Therefore, it may take some time to get down to the 464 even level if prices really want to. At the moment we have some congestion between 489 even to 490.10, quite a narrow band of support that has been breached but not broken, though it has been broken back in late January. It consists of the April 2017 high of 489.10 plus congestion from late 2021 to early 2022, including a quad bottom back then, along with the neckline extension to the April 21 head and shoulders top, currently 489.70. Sugar white premium spread. Now, some interesting gyrations here in recent times. 5 weeks ago we had a weekly key reversal up, though it was also a weekly indecisive doji cross, yet with the highest close since mid-July last year. Then, 4 weeks ago, we had an even more dramatic immediate countering key reversal down, closing below the declining gold long moving average, currently at 105 even. Then 3 weeks ago, we had a counter to the counter combined bullish harami and bullish closing white Marubozu. This was followed 2 weeks ago by a third countering bearish dark cloud cover pattern and bearish double, with last week an inverted hammer pattern. Now, an inverted hammer pattern is traditionally seen as a bullish reversal pattern. However, the data indicates differently in that between 6 to 7 times out of 10 it acts as a bearish continuation pattern. The question this week is whether the market will follow the tradition or the data. More on this shortly. So first, all this earlier massive toing and froing up and down, still even today, has prices bracketed just about by the familiar old gold long 1 year moving average below and on the top side, which is currently at 105 even, and on the top side by the significant twin combination of 50% Fibonacci lines of the July 19 to September 22 move at 128 3/4 and the August 21 to September 22 move at 131 1/4, plus the June 2020 high just above at 134 1/4. Overall, we have seen the action over the past weeks as a halt in the break up and out of what was originally a descending wedge pattern that developed into a big bear channel from April 24 to the end of January 25, and a potential move lower, possibly back towards the comforting congestion below, seen between September last year to January this year. Now, I had previously raised the issue, or the question I should say, 5 weeks ago, and I quote, is this enough to start talking about a possible bullish halfway hesitation from the start of the year, or else a topping action? At the moment, I'd still favour the idea of a possible bullish halfway hesitation, but I can now start to see the merits of a topping action. End of quote. Looking today at the market, I am more and more minded to view the topping action favourably and start discussing the congestion below between roughly 85 even down to 70 even. This is why I said 8 weeks ago, and I quote, apart from this gold long moving average, we really don't have that much below until we start approaching the 85 even zone. End of quote. Nothing seems to have changed on this for many weeks now.
Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.